Okay, now I'm going to go through number 35. So on November 1st, 2017, Bernard Company, a US-based company, sold merchandise. So I need to make sure I know they sold merchandise. So actually I'm going to write this table. So why don't you take this table right there and write it up just like I have done here, okay? So then I need to know I sold merchandise for 100,000 foreign currency units. So I have that information up there, with payment to be received on April 30th. At that date of the sale, they enter into a 6-month forward contract to sell. So I'm going to sell foreign currency. So notice I sold merchandise, so they're handing me foreign currency. And then I need to turn around and sell that foreign currency to get US dollars. So I need that information to know if I'm better off or worse off. They properly contracted as a designated as a cash flow hedge, which basically they're doing it more long term, I guess, than short term. And a fair value hedge we'll do I think in 36. But anyway, so the borrowing rate is 12%. And the present value factor for 4 months and an annual rate of interest 12% is 0.9610. Okay, so notice, we'll come to that in just a second. Okay, so when I show you the solution, they're going to have a lot of information there they do on a chart. I don't always do the chart. Feel free to do the chart. I just like to take it one step at a time. I basically have the chart kind of filled out, but not necessarily. So the first thing I want to do is figure out if I have a discount or premium. My 0.21 and 0.20, so that difference is 0.10 between those two. And notice that my discount or my forward rate is less than that, so this is called a discount. So probably if I would insert a row there, this is a discount. Okay, the discount has absolutely nothing to do with whether it's a debit or credit. The discount is going to be flipped if it's a debit or credit based on whether it's a payable or a receivable. But how I know it's a discount is the forward rate is less. Okay, so again, like the other one, I want you to have these two columns here. And so I'll pause this while I get this. Okay. So the first thing on November 1st, I record my original transaction where I sold the merchandise and I entered into the forward contract. So I sold merchandise, so it's accounts receivable and sales, and I have 100,000 foreign currency units times 0.21, so it's 21,000. So right now my accounts receivable is sitting at 21,000. All right. The forward contract, again, I just signed an agreement, so there's no entry. The next, on November 1st, I have to adjust my forward contract. On December 31st, since it's year end, I need to adjust my forward contract to 0.19. So notice now it's going, my accounts receivable is a debit. So I need now it to go to 0.19 times 100,000 or 19,000. So also you can just look at them individually. My accounts receivable is going down. So I need to credit accounts receivable by 0.02 times 100,000 or $2,000. Now I'm going to go to my hedge side. Okay, and again, I do them in a different order, but the first one I offset my gain or loss. Since this is a loss up there, I have a gain here and I debit to AOCI. The second one is I adjust my forward contract to its fair market value. Okay, so let's look here. I'm selling foreign currency. Go back for a second. I'm selling foreign currency. Would I rather sell it for 2.20 or 0.17? I would rather sell it for 0.20. I'm getting more out of it. So I know it's going to be an asset. So I can go ahead and debit forward contract because I've just determined it's an asset. I would rather sell it for what I have to sell it for. If I had waited and hedged it on December 31st, I would have only got 17 cents for each foreign currency unit, and I would rather get 20. So I know it's an asset. Now the question is how much? Okay, I know that it has gone down by 0.03, so 0.20 minus 0.17 is 0.03. I don't care about the negatives in this. The negatives are irrelevant. And I know I have 100,000 foreign currency units. So I simply take my 0.03 times 100,000, I get 3,000. Okay, now I have to discount it back from December 31st, I'm sorry, from April 30th to December 31st. So I'm not settling it until April 30th, so I have to bring it back. So I have January, February, March, and April. So I need my discount rate for 4 months. Go back to your problem and you'll find that's given to you at 0.961. And so I take 3,000 times 0.961 and I get 2883. So my forward contract is 0.2883. So right now I need to remember that value, 0.2883. I might just type it down there. I'm sorry, not 0.2883, 2883. Okay? So first one, offset your gain or loss. Second, adjust your forward contract to the fair value. Third one is amortize your premium or discount. Okay, so let's see that I have that. All right. So I've got my 10 cents is a discount times 100,000 is $1,000. I count my months. I'm going to go from November to April. So November, December, January, February, March, and all of April. First time I did this problem, I counted my months wrong, but I've got 6 months. So that's 166.67 a month. And here in this one, I'm amortizing it. Amortization always takes place over months in the past. So November and December have passed, so I have 2 months. So 2 times the 16667 is 3333. I don't care if you round it or not. Okay, it asks for the change in net income for the year. So I need to do that. I can't move my screen unless I have that off of draw. So here I have sales. Again, I don't necessarily like this because there would be accounts receivable, sales, cost of goods sold, inventory entry. So the impact on net income, I would prefer it if they either put the cost of goods sold in here or leave this out and just say what is the impact on net income of the exchange. But since you have to do it in your homework the way the book does it, etc. But please understand where I'm coming from, that they have left out the cost of goods sold. So notice I have an offsetting gain and loss, and my impact on net income is simply the amortization of that premium. Okay, so one more thing that I should do, I'm sorry, discount in this case. I need to make sure that you understand that why it's an expense. Okay, so notice that I'm selling my foreign currency. I know that it is a discount because it's gone down. Now I have to ask myself, am I better off or worse off? If I had not have hedged, if they would have paid me on that exact date, I could have sold it for 21 cents. Now I've signed a contract to get 20 cents, so I am worse off. So this is going to be an expense, not a revenue. If this were flipped and this was 0.22, it would be a revenue because I'd rather sell it for, I'm happy that I can sell it for 0.22 instead of 0.21. So it's an expense. First of all, 2 steps. Premium or discount, this is less, so it's a discount. Second, am I better off or worse off? I'm worse off, so it's an expense. Same steps for the next date. First, I adjust my accounts receivable. My accounts receivable is now sitting at 19,000, and I want it to go down to 18,000, which is 100,000 times 0.18, or you can just say it's going down by 0.01 times 100,000. So I get my accounts receivable down by $1,000. So now my accounts receivable is sitting at 18,000. Please remember that for your settling entry. All right, my hedge is sitting at 2,883. And now I know that this has to be 0.18 because if the spot rate on April 30th, the forward rate on April 30th to April 30th has to be the same. So notice this is kind of a good one to see because now it went down and now it's going back up. Okay, so this is where I'm going to take the whole entire thing. Let me double check that I have the right numbers down there. It's sitting at 2,883. Okay, so I put it right down there. That was genius. Kind of wish it was up here or something. Okay, and remember, in this case, it's an asset, 2,883. So if I had better use of my screen up here, I would put that on the debit side, but I don't. So I'm going to leave it like that. Okay, now I'm going to do the entire thing. Okay, so instead of just doing this change, I want to get the entire change because it's going to ease this flipping thing from at first it went down and now it's going back up. So I don't take my journal entry the wrong way. So I now know that instead of 0.03, the difference, I want 0.02. And again, the direction doesn't matter. If you want to make the direction matter, you can, but I just know they're a debit or credit. So now it's got to be 2,000. I have no present value because I'm on April 30th. So right now what I want this to do, so pretend this is the debit side, this is the credit side. I want it to be 2,000. So the question is, how do I get my forward contract which is sitting at 2883 right now, to be 2,000. So if this is debit and credit, I need to credit it for 883. Okay, I don't have any time value of money now because it is the settling date. So let's go to our 3. All right, so entry number 1, offset the gain or loss. Entry number 2, adjust my forward contract to its new value. It needs to be 2,000. Why does it need to be 2,000? Because 2,000 minus 0.18 is a $2,000. I am better off. Don't say I'm worse off now. It's just the journal entry that's flipping. If it was worse off, my journal entry would be quite a lot larger to go from a debit to a credit. But anyway, I just want to go from a debit to a smaller debit. So I credit my forward contract for 883. So now my forward contract is sitting at 2,000 and my accounts receivable are sitting at 1,800. That's kind of important to see. All right. And so then I allocate my discount expense. So remember that I had, 2 of the months gone. So now I've got January, February, March, April. They were 6 months here. So plus that times the other 4 months. And I get 666.67. Okay, so I've done my 3 steps. I have adjusted the gain or loss. I have adjusted the forward contract to 2,000, and I've allocated the rest of my discount expense. And again, it was discount expense above, so now it's still discount expense. Now I have to settle the thing. Okay, I don't really want to lose those, but I'm going to have to. Okay, so to settle it, I'm selling foreign currency. So before I sell the foreign currency, I have to get the foreign currency. So the first thing I'm going to do is going to get the accounts receivable off my books. The accounts receivable is on my books for 18,000, and I debit foreign currency. Notice that it is the same, but it's got to be the same because I adjusted my accounts receivable to 18,000 here, which is the spot. So this is technically the 100,000 foreign currency units times 0.18, which is exactly how we got the accounts receivable. So they should equal, but it's technically the fact that I've adjusted both to 0.18. Okay, now I turn around and get the foreign currency off my books. I get cash. Remember, I agreed to sell it for 0.20. That's why I highlighted this or drew a box around it. So I'm getting $20,000, and my forward contract is on my books for 2,000. So I'm getting off my books. So again, the impact on net income in year 2 is a little more clear because I don't have the cost of goods sold sales thing. And I have an offsetting gain or loss in the discount. So this, in both years, the only impact on net income is this 0.10 difference there. Okay, 36, I believe. Yeah, 36 is a fair value hedge. And again, the fair value hedge is an easy jump because I have the same on the regular side. And on the other side, I have the forward contract one with it hitting net income. So you can kind of see this one. Oh, 36, I guess, has different numbers. Okay, so maybe I'll go through 36. I'm not sure, but I'm going to stop this.